How's it going, everybody? I'm the BTC Reaper, and my goal on this channel is to teach you how to reap the rewards of trading, whether the price is going up or down. Welcome to Mastering the Trade Part 3. What is cryptocurrency? So we covered cryptography and blockchain in the previous two parts. If you missed those, you will want to watch those because they are the underlying technology for what makes cryptocurrency possible. Without either cryptography or blockchain, we would not be able to have cryptocurrency. Cryptocurrency is a digital, encrypted, and decentralized medium of exchange. Unlike the US dollar or euro, there is no central authority that manages and maintains the value of a cryptocurrency. Instead, these tasks are broadly distributed among a cryptocurrency's users via the internet, so buying on the open market, supply and demand. You can use crypto to buy regular goods and services, although most people invest in cryptocurrencies as they would other assets like stocks or precious metals. While cryptocurrency is a novel and exciting asset class, purchasing it can be risky and you must take a fair amount of research to understand how each system works fully. That means look into the teams. If you like XRP, look into who's behind XRP, see how big of a following they have, see what goals they hope to accomplish, how they have accomplished previous goals, and determine if they can accomplish future goals. Bitcoin was the first cryptocurrency first outlined by a principle by Satoshi Nakamoto in 2008, paper titled Bitcoin, a peer-to-peer electronic cash system. That was Bitcoin's white paper. We will cover white papers in the next video. Nakamoto described the project as an electronic payment system based on cryptographic proof instead of trust. So it uses cryptography to verify the transactions instead of a trust-based system. The cryptographic proof comes in the form of transactions that are verified and recorded on a blockchain. So that's how cryptography and blockchain make cryptocurrency possible. We covered a little bit about what is a blockchain. This will cover a little bit more. So a little bit of review from last video. A blockchain is open distributed ledger that records transactions in code. In practice, it's a little like a checkbook that's distributed across countless computers around the world. Transactions are recorded in books that are then linked together on a chain of previous cryptocurrency transactions. Imagine a book where you write down everything you spend money on each day. That is how a blockchain ledger would look, as it would be the entire book's pages would be your blockchain. Each page would be each block. With a blockchain, everyone who uses cryptocurrency uses their own copy of this book to create a unified transaction record. Each new transaction, as it happens, is logged in every copy of the blockchain and is updated simultaneously with the new information, keeping all records identical and accurate. To prevent fraud, each transaction is checked using a validation technique such as proof of work or proof of stake. Proof of work is a method used where you use a machine to use an algorithm that provides a mathematical problem that computers race to solve. So Bitcoin mining rigs are used to solve mathematical problems, to break the cryptography and verify that what is being sent and received are the same values and that the data is proper. Each participating computer, often referred to as a miner, solves a mathematical puzzle that helps verify a group of transactions, referred to as a block, and then adds them to the blockchain ledger. To race to solve blockchain puzzles, this takes a lot of power and electricity, and that means you might barely break even on buying a crypto mining rig because you are in a race against other people that have a lot more machines than you may have, so it takes a lot of initial capital in order to be competitive. Proof of stake, it still takes a little bit more power and a little bit more money in proof of stake, but you don't have the electricity costs behind it. With proof of stake, the number of transactions each person can verify is limited by the amount of crypto you're willing to stake or temporarily lock up in a communal safe for the chance to participate in the process. Each person who stakes is eligible to verify transactions, but the odds that you'll be chosen depend on how much you put in. Because proof of stake removes energy-intensive equation solving, it's much more efficient than proof of work, allowing for faster verification and confirmation times for transactions. So Bitcoin takes about 10 minutes. They use Solana. I'm not a big Solana fan, but Solana can do 3,000 transactions per second, so way faster than Bitcoin. Algorand has a possibility to do 6,000, so twice the capacity of Solana. sleeping giant in my opinion. So these are both using a consensus mechanism to verify transactions. One is using a algorithm and the other is using a proof of stake consensus mechanism. They are slightly different. One uses power consumption, the other doesn't. It's just too expensive to mine, people say. Too many people have optimized their equipment and technology to outcompete them. For Bitcoin mining, you need 127 terawatt hours for an annualized rate of Bitcoin mining that exceeds Norway's entire annual electricity consumption. So it takes a lot of power to do this. That's not to say it's terrible to do, but it does take some power. If you're trying to make a payment in cryptocurrency, you'll most likely need a wallet. So one type of wallet is a hot wallet, a software program that interacts with the blockchain and allows users to send and receive their stored cryptocurrency. If you want to know the differences of wallets, we do cover those in the original Intro to Crypto. I think it's Crypto 101. So if you want to see what the wallets are, visit that playlist. We'll cover that. We will cover that in future videos, but it's going to be a little bit before we cover those concepts, as we're going to jump more into the trading concepts soon. We have one more, a little brief overview that's going on from here, and then we will cover some other trading concepts. One last concept for cryptocurrency is a fork. A fork is a change in code. Cryptocurrencies like Bitcoin and Ethereum are powered by decentralized open software that anyone can contribute to, called blockchain. They're called blockchains because they're literally made up of blocks of data, and they are traced all the way back to the first transaction on the network. And because they're open source, they rely on communities to maintain and develop their underlying code. Every coin you invest in basically needs a strong community behind it. If it doesn't have a strong community, it's going to be hard for that coin to take off and keep moving. A fork happens whenever a community makes a change to the blockchain's protocol or basic set of rules. When this happens, the chain splits and can produce a second blockchain that shares all of its history with the original, but it's going to do its own thing, and it cannot be backwards compatible. Why this is important is because most digital currencies have independent development teams responsible for changes and improvements to the network, much in the same way that changes to internet protocols allow web browsing to become better over time. Sometimes a fork happens to make cryptocurrency more secure or add features. Other times you may have a community at odds, so they go their separate ways. A soft fork happens to bring new features or functions, typically within the programming level, to both Bitcoin and Ethereum. Because the end result is in a single blockchain, this does allow previous forks to be compatible with new forked blocks. So a soft fork is basically a change in code, like Ethereum changing over from proof of work to proof of stake. That was not a soft fork because it created a whole new coin. An instance like that is more of a hard fork. A soft fork is like the upcoming update to Ethereum that will help increase transaction speed and hopefully reduce the cost of gas. A hard fork happens when the code changes so much that a new version is no longer backward compatible with earlier blocks. In this scenario, the blockchain splits in two, and the original blockchain and the new version that follows the new set of rules and creates a new cryptocurrency, similar to Bitcoin Cash and Bitcoin Gold. They evolved from the Bitcoin hard fork because they had different ideas that the Bitcoin community weren't on board with, so they created a hard fork to do their own thing. So this is a little bit on forking and what it means. It is not something you eat your salad with when talking about crypto. Thank you for watching this third video. We look forward to seeing you in the next informational video, and then we will get more into the nitty and gritty stuff from there. Thanks for watching today's video. Have a great day.